Trading is one of the loneliest professions in the world when you actually take it seriously. And that loneliness is not romantic or noble. It is dangerous because isolation slowly bends your thinking without you noticing. And by the time you realize it, the damage is already done. I learned this early, and then relearned it painfully across the dot-com collapse, the 2008 crisis, and the COVID shock, because every time I tried to carry the weight of decision-making completely alone, my blind spots grew larger, my mistakes repeated more often, and my confidence drifted further away from reality. Markets don't punish you for being alone. They punish you for being unchallenged. And when no one is there to question your logic, your ego quietly fills that vacuum. When you trade in isolation, your mind becomes a closed system. Wins reinforce whatever story you already believe. Losses get rationalized instead of examined. And over time, you stop learning without realizing it. A trading community, when it's the right kind, breaks that closed loop. It introduces friction into your thinking, and friction is not an obstacle, it's a safeguard. Being forced to explain a trade to other disciplined traders often reveals weaknesses you couldn't see on your own, not because you're unintelligent, but because no one is objective about their own capital. The value of a community is not agreement, it's perspective. And perspective is something you cannot manufacture by staring at charts longer. I remember after the dot-com bubble burst, when the noise faded and many confident voices disappeared, the people who remained were not the loudest or the most certain, but the most reflective. I gravitated toward a small group of older investors who had already survived earlier cycles, and what struck me immediately was the absence of bravado. Nobody was selling certainty. Nobody pretended to know what would happen next. Conversations revolved around risk positioning, and most importantly, what could go wrong. Hearing experienced people openly say, "I don't know," was more educational than any market call, because it reframed uncertainty as a professional stance rather than a weakness. A healthy trading community does not make you feel safe. It makes you think clearly. It doesn't hype your good trades or excuse your bad ones. It questions both. When you share an idea in such an environment, you are not looking for validation. You are inviting scrutiny, and that scrutiny is where growth happens. Over time, this process sharpens your standards. You become more selective, more deliberate, not because someone told you to be, but because you no longer want to explain sloppy decisions out loud. Accountability, when it's voluntary and peer-driven, is one of the strongest forces for discipline in this business. Mentors take this one step further. A real mentor does not give you trades, and they certainly do not give you certainty. What they give you is context, perspective, shaped by scars you don't yet have. A good mentor compresses time by helping you recognize patterns before you're forced to live through them repeatedly. One of the most important lessons a mentor ever taught me was not about entry or exit, but about survival. He asked me calmly, what happens if I'm wrong, how much I lose, and whether I can still function emotionally and financially afterward. That question changed how I approached every decision from that day forward. Mentors don't stop you from making mistakes. They make sure your mistakes don't end your career. Communities and mentors also play a critical emotional role during extreme market conditions. In crises like 2008 or COVID, fear isolates people. Screens turn red, narratives turn apocalyptic, and traders retreat inward, making rushed decisions in silence. Those who had trusted peers to talk to did better, not because they had superior information, but because they weren't alone with their fear. Sometimes hearing another experienced voice say, "Slow down, protect capital, this will pass," is enough to prevent irreversible damage. Markets test your nervous system as much as your strategy, and community helps regulate that system when pressure peaks. That said, not all communities are assets. Many are liabilities disguised as support. Groups built on hype speed and shared certainty are echo chambers, not communities. They reward confidence over caution and participation over judgment. I've seen entire rooms of traders rise together on excitement and fall together when the story breaks. If a group discourages doubt, mocks risk management, or treats questioning as negativity, it is not helping you grow. It is training you to abandon discipline in exchange for belonging, and that is a terrible trade. One of the quiet benefits of trading communities and mentors is normalization. Every trader believes their struggle is unique, their drawdowns more personal, their doubts more damning. They aren't. Hearing others describe the same cycles of confidence, fear, impatience, and regret removes shame from the process. When you stop treating difficulty as failure, you stop forcing outcomes. And when you stop forcing outcomes, your decisions improve. That psychological shift alone keeps many people in the game long enough to actually develop skill. As the years pass, your relationship with community changes. Early on, you look for answers. Later, you look for calibration. Even now, after decades in markets, I keep a small circle of experienced investors, close not to copy trades, but to sense-check my thinking to make sure I'm not drifting too far toward arrogance or paralysis. We talk less about what to buy and more about what to avoid. That kind of dialogue keeps you grounded when markets get loud and seductive. And this is where the deeper lesson emerges, because the true benefit of trading communities and mentors is not information, it's transformation. The slow reshaping of how you think about risk, uncertainty, and responsibility. Moving you from reactive behavior to deliberate process, from emotional decision-making to probabilistic thinking, from fighting alone to learning in conversation while still owning every choice you make. And once you understand that the next question becomes unavoidable, how do you choose the right community and the right mentor without becoming dependent? How do you learn from others without outsourcing judgment? How do you accept guidance without surrendering responsibility? Because that boundary is thin, and crossing it without awareness can quietly weaken you over time. And that is exactly where we need to continue next. As we move from understanding why communities and mentors matter into learning how to engage with them wisely, so they strengthen your discipline and long-term survivability, rather than feeding comfort and illusion when things are going well and the market hasn't yet reminded you who is really in control. By understanding that the moment a community or a mentor becomes a source of comfort rather than clarity, you are already drifting into dangerous territory, because markets do not reward comfort. They reward honesty, and honesty is often uncomfortable. The first thing I look for when deciding whether a community is worth my time is how it treats uncertainty. In healthy groups, uncertainty is normal. People talk openly about what they don't know, what they're watching, what would make them change their mind. In unhealthy groups, uncertainty is treated like weakness, and confidence is performed loudly and constantly. That performance may feel inspiring in the moment, but it trains you to hide doubt instead of examine it. And hidden doubt always shows up later as oversized risk. The right community also respects process more than outcome. Good trades that followed bad logic are questioned. Bad trades that followed good process are respected. This distinction matters more than most people realize. If a group only celebrates winners and ignores how those winners were achieved, it slowly rewires your brain to chase results instead of refining decision-making. Over time, that erosion shows up as inconsistency. You start taking trades that look good in hindsight, but feel wrong in real time, and you don't know why your confidence keeps collapsing under pressure. A process-focused environment protects you from that drift. Mentorship requires even sharper boundaries. A mentor should never be the source of your conviction. If you feel unable to act without their confirmation, you are not being guided, you are being replaced. The mentors who shaped me most were the ones who pushed responsibility back onto me relentlessly. When I asked what they thought, they asked what I thought first. When I wanted reassurance, they asked about my risk. When I complained about the market, they asked about my behavior. That wasn't always pleasant, but it was formative. The goal of mentorship is not to reduce uncertainty, it is to increase your capacity to operate within it. Another critical skill is learning how to listen without absorbing everything. In trading communities, you will hear many opinions, some brilliant, some reckless, some simply irrelevant to your time frame and temperament. Wisdom is not knowing who is right. It is knowing what applies to you. I learned to filter everything through a simple lens. Does this align with my risk, tolerance, my time, horizon, and my rules? If it doesn't, I let it pass without argument or attachment. This protects you from the subtle pressure to trade someone else's game with your own capital, which is one of the fastest ways to lose both money and confidence. You also need to watch how a community behaves during drawdowns. Anyone can sound intelligent in a rising market. The real test comes when things go wrong. Healthy groups slow down. They talk about reducing exposure, preserving capital, reassessing assumptions. Unhealthy groups double down on narratives, search for villains, and encourage loyalty to losing ideas. If a community becomes louder and more emotional as losses mount, that's your signal to step back. You are there to sharpen judgment, not to borrow conviction when your own discipline is being tested. Over time, if you engage correctly, something subtle but powerful happens. You stop needing communities and mentors to tell you what to do, and start using them to check whether you are drifting from who you are as a trader. They become mirrors, not maps. You don't follow them into trades, you consult them when emotions run high or confidence swings too far in either direction. That relationship preserves autonomy while still giving you the benefit of shared experience, and that balance is where real growth lives. I want to leave you with one hard-earned truth before we close this chapter. The market will always eventually leave you alone. In the heat of a fast move, in the quiet of a drawdown, in the moment where a decision must be made. Now there will be no community, no mentor, no second opinion. There will only be you, your rules, and your ability to execute under pressure. The purpose of communities and mentors is not to replace that moment, but to prepare you for it. If they are doing anything else, they are not helping you no matter how supportive they feel. And that is why, when used correctly, trading communities and mentors are not shortcuts. They are safeguards. They don't make the path easier. They make it more honest. They don't remove responsibility. They sharpen it. If this lesson resonated with you, I encourage you to subscribe to the channel so you can continue learning through lived market experience rather than hype, and leave a comment sharing what you've learned, good or bad, from communities or mentors along your own journey. Because those reflections don't just help you. They help others recognize the difference between guidance that strengthens them and noise that quietly pulls them off course.